It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 15, Episode 1, that makes it Episode 85 in the aggregate, starts here. Ladies and gentlemen, first of all, I would like to open with an apology. Having been concerned about FTX for quite some time, we have been somewhat in the vanguard of calling its issues and subsequent decline through the pages or the pixels of the Exchange Invest newsletter, amongst other fora, including this live stream. We don't owe FTX an apology, but I would like to say sorry to the many Exchange Invest subscribers who have been forced to clean their device screens while reading Exchange Invest in recent days, as our revelations on FTX have proven coffee-splutteringly incredible. The net result is a big question mark over the benefit of an Ivy League education, other than the innate sense of superiority. As it appears, FTX was a frat boy fiasco, which defied even the first module of How to Run a Business 101. Now, I've previously expounded the Anna Karenina theory of crypto exchanges, and to describe the situation as confused amidst the bit carnage would be a severe understatement. The worry now is who collapses next as bit carnage gains momentum. In the midst, some would say it's impossible at this juncture to see big names disappear, but then again, FTX did. Now, Econex has filed for bankruptcy. NYDIG is apparently under duress, with Genesis and Grayscale part of that entity and hugely in problems. Mega humble pie digestion of the week, not by us once again. The ASX finally gave in to the inevitable and realized that after a ludicrous $170 million spend, it has to abandon the digital asset delivery, non-delivery of technology. Chess, the settlement system, is still decades old, and the self-styled tech company ASX has a distributed ledger image problem to contend with. But at least they finally bit the bullet. And finally, for our intros today, a delightful anniversary. Happy birthday to ICE on the 40 years of the long gilt futures contract. That's been the sovereign UK bond benchmark future through the Royal Exchange through Cannon Bridge, both of those floors, and of course in the hands of ICE as an electronic exchange after being originally taken electronic by LIFFE itself. 940 million contracts have been traded, and more amazingly still, where a pint of beer has gone from 62 pence in 1982 to £4. LIFFE's long gilts, nowadays ICE's long gilts, are still only 28 pence to execute and clear, the same fee that they were charging on the LIFFE floor in 1982. Now, our guest today knows a great deal about the LIFFE floors, ladies and gentlemen, amongst many other things. The topic, Brendan Bradley, evolving markets, evolving careers. Brendan has been in financial markets for 35 years and is one of the world's finest product developers. Let me also add, I wrote that bit in his bio. He didn't, because he's very modest. Brendan Bradley is one of the world's finest product developers, having played a major role in the development cycles of LIFFE, DTB and EUREX. In his last major corporate role, he was an executive board member and chief innovation officer at EUREX, a very successful subsidiary of the Deutsche Boerse Group, where he was responsible for championing and brokering new ideas, both internally and externally, and looking for new opportunities within the changing market environment, either organically or through investments, particularly in the related FinTech space. Actively involved in backing, mentoring, and advising FinTech firms, Brendan is an MBA lecturer on FinTech strategy at the University of East London, co-author of FinTech for Dummies, and author of ESG Investing for Dummies. Brendan, welcome to this show. Where in the world are you today?
I am sitting just on the outskirts of London, in my home. We tried to not say too much about the fact that we're just the other side of the Essex border. So we always prefer to say that we're in London.
In London, arguably, well, of course, the Essex border itself has moved on various occasions, hasn't it? So therefore, I suppose we can always argue about the municipalities of Britain. It's one of those complexities of life. Let me add, it's a pleasure to see you today. And also, hello to Christmas, Sina at Messy Times. Delighted to see that you think we're looking good today. Great to see you too, Chris. Thanks for tuning in. And hello to Marcus Ward. Good evening, Marcus. It's a delight to see you here again as well. Thank you so much. If you've got a question for Brendan, of course, we'll be happy to take them throughout the show. And don't forget, do please give us a little bit of love, ladies and gentlemen. Every like helps push us up through the AI bots, whether you're watching us on Facebook, on LinkedIn, or YouTube this evening. So, Brendan, evolving markets, evolving careers. That's our theme for this evening. My goodness. Well, I mean, I suppose one could draw parallels between our careers, but that's probably very ugly and boring. But at the same time, you've been going through quite a lot of, well, innovation and evolution in your own career of late, haven't you?
Yeah, indeed. As you mentioned last time round, my major corporate career finished around 6 years ago now with EUREX. And given the fact that I'd actually been looking at a lot of FinTech investment at the time, then I decided to kind of branch out and look at it on my own. So that's what I've really been focused on for the last 6 years. And then more recently, there's been the authoring that you just mentioned.
Yeah, so very interesting. I mean, I think you yourself were saying the other week that you reminded yourself of sort of Serena Williams, and that you're not retiring from financial markets, you're just evolving into a different sphere. And it's certainly been, I mean, very exciting. But if you look at, I mean, where you came from, where we both came from, I mean, actually, we were both on the floor of life at one point in time. It's quite exciting to see the change that has gone through markets, isn't it?
No, I mean, it's incredible. You're talking about the 40 years of life. That was where I kind of cut my teeth back in 87, where I started at LIFFE. And yeah, I think if I look at that at the time, I only had 3 months on the LIFFE floor before we got the October 87 crash. So there's lots of stories, obviously, around kind of being on the floor in those days, and then gradually morphing from there up to business development. But, you know, obviously LIFFE very much rode the wave during that period where you had the Berlin Wall coming down. They benefited from effectively the 87 crash, showing that treasuries and Eurodollars continued to trade in London while they'd hit limit up in the States. And that gave us really the opportunity then to go in and launch a whole bunch of European products, particularly the fixed income side, to start with, and then the equivalent short-term interest rates. So yeah, that was a hugely sort of rewarding period, I think, from 87 up until 95, where LIFFE really carried everything before it, I think, at that point.
Yeah, it's amazing, actually, when you think about those product histories. And actually, you hit on one great one, October the 19th, 1987, Black Monday, when all the US markets opened and promptly went limit. And in fact, they had Eurodollars and Treasury bond futures in LIFFE, which eventually got taken away for various other reasons, and they were uncompetitive. But as I seem to remember, actually, Tullett and Tokyo's analyst at that time, Bob Tomkus, famously writing his report, and he said, LIFFE reigned supreme. That seemed the day that we were going to take over the world. But it was actually quite incredible to see those sorts of things going on. And yeah, it's funny how you telescope your career. It seems like ages between that day in 1987 and the Berlin Wall failing, but actually when you look back on it, it was kind of, well, only a few weeks apart, almost 18 months. Quite remarkable. Actually, I'm going to jump straight to a couple of points that people are bringing from the audience. First of all, our mutual friend, Jonathan Cowan. Hello, Jonathan. It's lovely to see you. Thanks very much for checking in. Thank you, too, for your very kind words about my book, Victory or Death, on Amazon.com. Really appreciate the 5-star write-up there. Most welcome. Thank you so much, Jonathan. Looking forward to this one all. I agree completely. Hello, Peter Secon. Hello also to Ari. Hope you're great, guys. Evening all. Apologies, having internet problems. Well, I hope you can manage to stick through the show. But if you can't, don't forget, there will be the rerun of this perpetually. Now, actually, I'm going to jump straight to your question, Brendan, because Christmas Cena has asked a really corking question. Brendan has splendid experience. Completely agree with that. My one question is, which product do you remember best that you thought was absolutely brilliant, but political or other forces prevented it from being launched?
So I would suggest credit futures would be the one I would put in that camp. So it wasn't the fact that it wasn't launched, but when I rejoined EUREX back in 2006 and was responsible for both the fixed income and equity index product development, they had already started the process of launching the credit futures on the iTraxx indices. And yeah, that was sort of something where credit was obviously all the rage prior to the financial crisis. And so therefore we thought that we had a great chance of actually providing something really useful to the marketplace at that point. But I would suggest that the vested interest, shall we call it, of the sell side, unfortunately prevented that one from actually going any further than we kind of would have liked it to have gone. And without the support of those guys, obviously, then it was an intellectually sort of interesting process, particularly having to talk to the local state of Hesse with respect to the margin levels that we were actually considering putting in place. But unfortunately, didn't really take off the way we would have liked to.
Fascinating. That's a really, really interesting example, and wasn't the one that I was going to think you were probably going to talk about. I wasn't sure what you were going to say, but I thought it hadn't occurred to me. So essentially, I mean, that came undone because what, the sell side just weren't happy and they put a lot of pressure on the market overall?
Effectively, it was one of those where they kind of said, you've already got the interest rate curve, be happy. We've effectively lost a lot of our edge through futures markets being so transparent. And so therefore, credit's our nice niche at this point in time. And so therefore, we'll keep that to ourselves. There was some suggestion afterwards that if we had been successful and if there'd been more transparency around the credit markets at that point in time through a futures functioning market, that you wouldn't have had the same issues with the crash that you would have had in 2008. But yeah, I don't think the only reason why that might have been the case was if somebody had come to us and asked us to be clearing CDO squared or whatever it may have been at the time, then we probably would have given that short shrift. So might have given everybody else the fact that they should have been steering clear of it as well.
Very, very interesting. Thank you, Chris and Sina. That's a really super question. So we're jumping around about this, but so, I mean, going through your career, Brendan, you started on the LIFFE floor, you went into marketing at the LIFFE exchange, and then soon thereafter, you were effectively poached, headhunted, and you were off to Frankfurt. What was that like as an experience in, what was that, the late 1980s, early 90s?
That was 95 that I went to Frankfurt, actually. So we'd had all the wave of all the new products from the product development side, actually, at LIFFE. I'd also managed to fit in a part-time MBA between 93 and 95. So I was a little bit frazzled by that stage in terms of the amount of work that I had to put into that. And we got to the end of my MBA, which was actually also coincided with the end of first quarter 95, where we were then kind of saying, right, so, what's the other new product development that we're going to be pushing? And we were being compared with first quarter 94 in terms of volumes. And first quarter 94, some people may remember, was a bond crisis. So therefore, volumes gone through the roof. LIFFE benefited from the fact that we had all of the fixed income products already launched at that stage across Europe. So therefore, we were in a great position from that perspective. All of the member firms had basically introduced new people onto the floor. You'll remember that it was by that stage on Cannon Bridge, so we had the space as well to be able to do all of that, although that looked pretty cramped very quickly sort of after that. But then the view was at that point that we need to pull in the reins and maybe not go gung-ho. It was almost like being a publicly listed company. So therefore, when kind of I got the call from, it was actually two of the ladies who'd done a lot of the marketing for Bund Bubble products at LIFFE, who were Andrea Belzer and Heike Harter. They'd actually been poached for DTB. They were working with Andreas Preuss. and Andreas asked them whether there was anybody in product development that they knew that maybe they should try and get over. And so that's how I kind of got the call to go over to Frankfurt at that point in time.
Absolutely fascinating. That sort of started a fantastic relationship with you working with those ladies and actually working with Andreas. And I think I'm not telling tales out of school here, because I know Andreas was always very voluble in saying that as far as he was concerned, you were the greatest product developer in the world, which I think is quite something. So you're sort of Ronaldo meets Lionel Messi of the product development world at that period. And I think it's absolutely fair comment actually as well, but something where it's always nice to be remembered by somebody like that, the man who was CEO of EUREX ultimately for quite a long period of time. Great comment there, just to go back to Chris Messina, Messy Times. HESA never changes in their aversion to objective evaluation of their credit risk. Excellent example. So thank you very much for that answer. And actually, I'm going to jump straight across. We're jumping around a little bit today, Brendan, but I know you're a man who can multitask. Peter Secon, thank you very much for your question. What's one of the biggest challenges facing emerging markets, in your opinion, and why?
Probably, I would argue that emerging markets don't have quite the same challenges as maybe they once had. Even in the financial market, there's always going to be some issues around governance, shall we call it, and what goes on various markets there. And there will be issues around the size of the market. So therefore, how much liquidity you can really get into any of the products that are there. An example of that would be that actually one of the things I did just before I was leaving Frankfurt in the 90s was work in Kyiv in Ukraine, which is unfortunately suffering at the moment, but a lovely city. Their approach at the time was we need a derivatives market. We were brought in to actually look at how we could actually help them develop that. And then we were introduced to their Spot FX platform, which was you basically went down to the floor at 5 minutes to 11. There was a bit of a huddle with some people putting pieces of paper in. And then just as they were about to get the fix, the central bank came in and wiped everybody out. They therefore determined what the fix was going to be. So it comes down to, I suppose, have you really got an underlying functioning spot market whereby you could actually create a derivatives market from that? So while it was nice to spend some time with them and lovely people, but we kind of came to the conclusion that there really wasn't anything for them to be working on at that point in time, and they should continue to develop the underlying markets first. And I think that's always going to be an issue with respect to emerging markets, is whether you're talking about, especially if you're talking about a derivatives market, have they really got a fully functioning market? Did they have the ability to allow arbitrage, as well as have the hedgers and the speculators in there? What's the functioning repo market like, et cetera, et cetera? So I think they're all the issues that they'll face. If you're talking about the more developed emerging markets, because of electronic trading now, they obviously can push their product a lot further than they would have done in the past. Therefore, the only issue there, I would argue sometimes, is that while they pander to some of the big technology providers by taking their product because they think it's good to be able to use that from a distribution point of view, I would argue that sometimes they should really look at having a more flexible local-based platform, or something that they can kind of be more bespoke with, rather than spending a lot of money on something which they're not going to really use it. It's a bit like having a Bloomberg terminal and using it just for IB chat. You've got basically all of the functionality that you could require, but you don't actually really use most of what you need.
Yeah, the example I often use when you see some of the smaller exchanges and the technology they buy is that they really could have done with a sort of Toyota Yaris or something like that, or a Mini Cooper at most, and ultimately they've gone off and bought themselves one of those Mercedes Formula One cars or something that needs about 25 people just to start the thing and change the tires. Yes, you're absolutely right. I think that's a very, very good piece of advice altogether. Thank you very much, Peter Secon, for that question. Very useful. If you got any other questions, ask them. We are discussing evolving markets, evolving careers here with Brendan Bradley, the former Chief Innovation Innovation Officer of the Deutsche Boerse, amongst many other things. So you moved through the Deutsche Boerse hierarchy. Everybody, it seems to me that almost everybody who's anybody, they had a period when they were in Deutsche Boerse, then they were out of Deutsche Boerse, or they were in EUREX and out of EUREX, and then back in again. And you did that hokey cokey yourself for a little bit of time. What was it like? I mean, going on to be, I mean, effectively in the vanguard, actually, in the exchange world as innovation officer. I'm not even sure. Were you the first chief innovation officer at an exchange? I can't think of anybody before you.
Yeah, I think it was Andreas probably came up with the title, actually. So I may well have been the first. I think what I had the fortunate sort of experience of, that first period in Frankfurt had gone particularly well. There was the small matter of winning the Bund futures back. And then we were headlong into preparing for the introduction of Euro. So therefore, we had the opportunity to introduce the Eurostoxx 50 and the Schatz at that point in time. And of course, they were largely because of the introduction of the Euro. You wouldn't have had a pan-European index if that hadn't actually been the catalyst behind it. Similarly, the Schatz probably wouldn't have been anywhere near as successful as a 2-year product if it hadn't had the combined issuance of all of the European entities that were actually providing the underlying for it. So kind of those sort of things for me were real catalysts for that. I probably could have continued to stay on in Frankfurt, but I'd had a 3.5-year stint at that point. And the Celtic Tiger was roaring in Dublin at the time. So I effectively decided to go and become an independent consultant in Dublin. So I was quite used to the pandemic sort of scene because I'd already been working from my back bedroom back then, watching the ferries coming into Dunleary. So from that perspective, I think, I then got the opportunity to work with firms like Hull Trading and Helios on the option side. And that was really a period then of, developing the call round market. So, they were very much electronic trading firms, but recognized that there was actually a lot of business that was going through upstairs that they weren't seeing, given that I'd had the period with LIFFE and then with DTB. I got to know quite a lot of the people that were actually pushing that business through. And so therefore, particularly on the options side, even to today, I suppose, a lot of the options products haven't really kind of moved as much as they might have done onto a pure exchange screen. And so therefore, it was helping those types of companies to actually then develop what was going on the upstairs market as well.
Yes, I mean, that whole call-around market is quite a fascinating thing as you managed to develop that. I hadn't thought about you developing it from your back bedroom in Dunleary, though. That adds a whole new, interesting, distributed twist to it as we talk about it, Brendan. Here talking about evolving markets, evolving careers with Brendan Bradley on IPO-VID tonight. If you've got any questions, do please drop them in. And so when I look through all of these sorts of things, is there a strand that you think over your sort of evolving career of evolving markets that is a backbone or related to all of the things that happened?
It's really looking for these catalysts, I think. If I think about, what was actually happening during those periods, fortunately, I had the period at LIFFE where there was really a lot of things that we went on, through markets, as we mentioned. That actually helped us actually develop the market there. When it came to the period of time in Frankfurt up until the end of the 90s, the introduction of the Euro, Russia crisis in 98, they were all things that were kind of bringing the markets to the fore. We had the opportunity then, I, as a consultant from Dublin, actually then went over to Chicago for a period of time during the EUREX US sort of launch, and the attempt to actually replicate what we've done with Bunds, which, as everybody knows, didn't really go down very well. Another thing that probably may be interesting for you is that there was actually a group of us that were looking at what we could or should be launching at the time, and we decided not to go with the the treasuries. but to go with energy instead. So we thought there was actually a better opportunity to compete with NYMEX and actually go that route. But the powers that be decided that it was far easier to actually compete with CBOT instead. And part of that, I suppose, was because we'd actually already given CBOT the EUREX platform. People were used to trading that. Part of the reason for the success of EUREX was, again, a catalyst, electronic trading, people trading into Bund futures from Chicago in the early morning. Was a catalyst towards all of that. And then I got the opportunity, I suppose, again, with Andreas coming back in as CEO, to take over the whole of the product development area. When I'd been there in the 90s, the fortunate piece that I suppose I had then was I was just there as a full-time consultant. So it gave me the opportunity to only focus on that. But there'd actually been a kind of dearth of new product development in that 2000 to 2006 sort of period on EUREX, where they'd either been milking the products that were still doing well and developing those after the introduction of the euro, trying to compete in Chicago, which was probably a distraction from other things that might be going on. So when I came back in 2006, Andreas's brief was very much a case of, let's get back to new product development. And so, that gave me the impetus then to be able to, if I was looking at a list recently of some of the things that we were kind of introducing at that time, we did the first MSCI products that were launched at that period. So getting the first licenses up and running. And of course, that's, I don't know how many licenses EUREX have now, probably 90 to 100 perhaps with MSCI. We looked at real estate products. We looked at insurance, hurricane sort of type risk. We were the first to look at dividend products. And then of course, from 2006 to 2008, with the financial crisis, you had another catalyst. So suddenly people that have been trading dividend swaps, OTC, were then coming to us as the exchange, first time I'd ever experienced that, and saying, we'd like to move these products or this open interest exposure on the OTC side actually into the clearinghouse. So that gave us an opportunity to obviously launch those products, and they've been very successful. And by virtue of the financial crisis, the yield spreads in Europe then widened. So we were able to go back to the future, as it were, and relaunch BTP futures, OAT futures. So that period where 2006 to 2010, it was just the number of new products that we were introducing. If you kind of look at the plain vanilla stuff alongside that, where we probably launched something like 400 single stock futures and single equity options at the same point in time. It was just full on in terms of all the various different sort of ranges of product, commodity indices that we tried. So we actually really had quite a plethora of different things that we'd gone across. Some of those worked better than others, but it was kind of really an experience of trying as much as possible to feed into, on one hand, the move from the issue of the financial crisis, of course, was then it was OTC bad, CCP good, with the push towards let's get as much into clearing. So another catalyst for us to be able to look at as much OTC exposure as possible. Inflation was something that we tried at the time as well. Maybe that's sort of something that might have its day again now, given the catalyst of what's going on at this point in time. So I think that's really the thread that I could sort of pick up, really the whole way through, was looking at various different catalysts with market. Everybody kind of thinks black swans don't happen very often, and yet when I look back over that period, every 2-3 years there was an event, whether it was a financial crisis or whether it was some other type of event that really triggered things. There was always an opportunity to kind of look at what was going on in the market and actually find sort of a way of doing that. So.
Yes, it's quite incredible when you look at that, and we seem to be having an unplanned event in the background for anybody who's listening to the sirens. I don't think they're taking me away, and they've already arrested the drug dealers next door, so therefore they're safely in jail. So I don't think it'll be coming for them either. Fascinating. You mentioned all of these areas of product development. I was actually going to mention one that you didn't mention, which did come out of DTB EUREX, which was, of course, Volax, which was the very first attempt to create a VIX-style volatility feature. And a lot of people think life began with the VIX. Very, very innovative product. What happened that Volax wasn't the thing?
There was an initial launch back in the 90s where Randolph Rote, who actually is one of the EUREX board members now, had been writing, I think it was probably his PhD, was on that. And while I suppose academically it was a sound product and the way further forward, we didn't necessarily still have at that point in time enough, I think, interest in option products per se in Europe, as would have been the case in the States. And if you think about what drives the VIX product in particular, is a lot of retail business that's actually feeding into the wings of the curve. And so from that perspective, there was a lot more impetus behind it, I think. And even with the VIX to begin with, it didn't really sort of take off as much as perhaps it could have done. But you suddenly had a lot more. Again, if I look at even things like Eurostoxx options, some of the largest trades that we would have seen going through in the Eurostoxx options would have been coming from hedge funds in the US. So there was a lot more kind of movement towards sort of that area. So I think when it was first launched, there really wasn't, it was on the DAX, and there wasn't really enough impetus there. When we launched it, actually, we relaunched with, it wasn't Volax then, it was actually VStoxx. And of course, therefore, it was based on the Eurostoxx, and you had a much more liquid underlying that you could actually then develop the index from. But again, it was, even though we had some market makers that were involved in that, that were from the US, that were obviously heavily involved in trying to develop the market around it, there really wasn't sufficient retail interest in Europe into listed options, and there wasn't, I suppose, enough education or interest from the buy side in Europe to really push it at that point in time.
That's interesting, actually. I'm going to come to a question from Stuart Heath in just a moment. Hello, Stuart. It's great to see you. But you hit a very interesting point there. I mean, the retail investor difference between the United States and Europe, and certainly it is very acutely noticeable, even though, I mean, liquidity in options in Europe has increased quite exponentially during the electronic era of the last decade. What do you think can be done to try and help bridge that gap in Europe to get more people interested in the options market a la USA?
I think in continental Europe, there is interest there. It's just that it's expressed in warrants as opposed to the listed options. So just historically, if you look at particularly Germany, Switzerland, Italy, they've all had thriving warrant markets that have developed, that the local branches have really been pushing retail customers into. So therefore, that's kind of where that's developed. If we look at it more so for places like Amsterdam and Stockholm, you do see a lot more listed options from there, and they seem to be a lot more familiar with it, and able to actually trade more product. But probably then the size of their markets isn't big enough to really develop it to the same extent. And then if you look at the UK, I think I'm right in saying that the best year that the London traded options market, as was, then morphed into LIFFE, the best year they had was actually 1987. And I think that probably a lot of retail got killed during the 87 crash, and they never came back, and they either then went into CFDs or spread bets or the 3 o'clock at Newmarket. So
Via Betfair, presumably, probably in order to get some extra optionality in there. But I think you're right, and I think the CFD market has been a huge issue in the UK. And yes, indeed, the bank-driven warrant market is quite sensational in continental Europe, leading us to, well, the opportunity to quip on the fact that EUREX, but the division of the Stuttgart Stock Exchange, is the most famous exchange in Europe no English speaker has ever heard of, amongst others. And of course, well, Deutsche Boerse and Swiss Exchange used to have a, they had one at one stage which was unfortunately branded as Scotch, as I seem to recall, which means in American patois street slang to steal with stealth, which some might regard as not being altogether unreasonable related to some bank warrants, but let's not go there, I suppose, at this point in time. Let's move onwards to a question from Stuart Heath. Hello, Stuart. Lovely to see you. I hope all is well in your world and you're enjoying the World Cup. Even given the ASX experience, can distributed ledger technology replace traditional clearinghouses and CCP eventually? I suppose we might even be verging towards FTX territory here as well, Brendan.
Yeah, for me, ASX really was the poster child that I think was the forerunner for most of the clearinghouses to take a look at, if ASX managed to pull it off, probably more of the other clearinghouses would look at it with a view to continuing to develop sort of areas there. My gut feel is that now that hasn't happened, that's probably pushed the idea of DLT for clearinghouses back even further. The question, I suppose, for some people is if it's for derivatives, given that derivatives is real-time risk, and you're not dealing with T+2 settlement and blah blah blah, then you could argue that the clearinghouses as they run today are actually fine in terms of the way they're operating. The view from ASX seemed to be that there was a lot of complexities that were there in the marketplace that couldn't be resolved. Now, whether that's an issue with respect to communication between member firms and the technologists at the exchange, not quite sure. But you would think that, for me, DLT has always really been around things like repo. So, especially now with a dearth of collateral that could be out there in the marketplace, if you want to be able to turn that collateral around quickly, you really don't want to be dealing with a repo sort of product where you're sort of waiting for T+1, T+2 settlement on the back end of the repo. So therefore, being able to turn that around quickly, I could really see there is or should be a lot of demand for some sort of blockchain related sort of product there. But I think if we're going to look towards the broader derivatives markets, I think that's been pushed back now by the ASX experience, rightly or wrongly. And then if I look at the things that kind of work, the DLT, it does really seem to be where there's almost a niche product where there's a smaller group of entities that effectively own the market that can actually come together and agree that it's in all of their interests to be able to do that. Whereas it sounds like with ASX, probably a lot of the clearing member firms didn't really believe that actually having T+0 on some of these things was necessarily in their best interest, given the fact that they could charge overnight for maybe obfuscating some of the settlement for a longer period of time. So I think from that sort of perspective, one area that the one blockchain firm that I actually have dealt with over the last 6-7 years, they were originally called Rise Technologies, they're now Calip, and they've been working on 2 projects, one around ADRs, where the issues with respect to issuance of ADRs actually is arcane, and so therefore there's an opportunity to do that, and there's a small group that's actually been helping them with that during the last sort of 6 years or so. And the other piece that they're looking at is carbon and the voluntary carbon credit markets. So I think there's opportunities there where that's a newer marketplace that's starting to develop. That's where I could see really DLT taking off rather than maybe in the established markets.
I think that's a very good answer altogether. Stuart Heath, let us know. By all means, come back with a supplementary if you'd like to add something to it. What I'd like to actually talk about at this juncture, I mean, talking about evolving markets, evolving careers, we did delve into product development there. And I'm just curious, not asking you to give a critique of specific exchanges, but is there anything at the moment in terms of the last, say, 5 or 6 years or more even of product development per se? How do you think overall exchanges have been dealing with the threats, the opportunities, etc.?
I think all of the exchanges / clearinghouses have been looking at the opportunity more now around, can we bring OTC products on exchange? So that's essentially not low-hanging fruit, but a more obvious look at it. And funnily enough, with Stuart asking the question, he's a very good example of that, where the total return futures that he launched at EUREX is the effective move of total return swaps away from the OTC area and actually into a listed cleared environment. Most of it is still by appointment, so you're not going to actually see much in a liquid order book on that stuff. But I think with respect to the idea of actually the success of a product like that, once you bring that into a clearinghouse environment, you then have cross-margin benefits against Eurostoxx futures, blah, 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 blah. So collateral tick, cross-margining benefits tick, and the ability to effectively continue to trade the way you do now today, but actually park it somewhere that's much more efficient. So I think all the exchanges are looking at that, and that makes a huge amount of sense. As I said, maybe inflation swaps is an area to be looking at the moment, given kind of some of the issues around LDI sort of businesses as well, whether the inflation sort of piece of that could be brought in and cross-margined against other things. So that would be kind of some of the areas there. The catalyst that I would see at the moment again now has kind of been one, the pandemic, in terms of what the issues are around the pandemic, but more so I suppose net zero, and that all kind of leads towards the reason why I looked at writing the ESG Investing for Dummies book. Was one, it was the pandemic, so therefore I put myself in self-isolation for about 6 months and actually wrote the book. And then secondly, what was the catalyst behind it? It's, well, if I think back now, I left the exchange in 2016. 2015 was the Paris Agreement. And so therefore, we've really started taking things much more seriously around where carbon markets are, emission sort of rights are, renewables. So if I look at the catalysts that are there at the moment, that's where the focus should be. I saw that Peter Wrights was obviously on your show some months back and mentioning hydrogen as an area. So they're kind of areas that will take time to come. But if you look back, all of these products that have been listed, you've really got to try and stick with them. If I think back to 2006, we were banging our heads against the wall on sector futures, for example, because it seemed obvious that now that you had a pan-European sort of exposure, most of the banks had gone towards looking at sectors as opposed to countries. And fortunately now, at least one of those came through with the banks actually volumes on the sector futures taking off. But if we look at the early days of Eurostoxx, probably took 2 years or so to really kind of get to any decent volumes. Dividend products the same. So you've really, I think, got to stick with all of these products as much as possible. And some of the exchanges have got deep enough pockets. It's just whether they're prepared to continue to support some of the ideas. But it's getting harder and harder, of course, to look at new product. Most of the things kind of have tended to be done. So therefore, it's what is that catalyst now? And that's where I think that's where some of the exchanges have to look at that. If they're predominantly financial exchanges like EUREX, it's probably harder for them to look at the commodity related areas. But instead, what they've done is go towards the ESG lookalike index futures. So that's, again, an easy win because effectively you're just taking one of the current indices and maybe putting a few exclusions in or whatever. Either that's going to then cannibalize your existing business, or you have to look for more thematic sort of type stuff. So that would be the other area I'd be looking at is, what's the thematic areas that you could be looking at on index futures?
Interesting index themes. And I mean, yes, you're absolutely right. Euro stocks took a long time to build. But in fact, I mean, even before that, LIFFE had the Euro track, which was just way ahead of its time. I don't think there was anything fundamentally wrong with the index per se. But the problem was in and around the time that was launched, which was the early 90s. And that was actually still on the LIFFE exchange, on the Royal Exchange, wasn't it? Before
Euro top, actually, Patrick.
Sorry?
Yeah, the Euro top that was actually
Euro top as well. Yes, you're right.
Was listed in Amsterdam. So
yes, you're right. And I think the problem both of those had was the difficulty was that people at that stage didn't think pan-European, and yet you put that to, I don't know, if you turn on CNBC today and tell them that, well, 25 years ago people weren't thinking, or 30 years ago they weren't thinking about pan-European stock trading. It's people would laugh at you, whereas quite incredible how everything became Schwabified across borders, and thank in part actually to MiFID, the original MiFID legislation, which actually helped that cross-border competition immensely. Admittedly, bringing the stock exchanges kicking and screaming to the table on that particular occasion, but a little bit like deregulation and commissions by Nixon, it ultimately made everybody more money at the end of the day. Fascinating stuff. Just popping back there to Stuart Heath. Agree with Brendan Bradley on both points. Distributed ledger technology will take ages, but the OTC product moving on to exchanges has only just begun to ramp up. That's incredible, actually, though, when you think about it. And I agree with Stuart totally. But here we are, 15 years after the crisis that provoked it finally. Good grief, 25 years or more after David Hardy was originally appending sort of any noun to the word clear and creating repo clear, swap clear, etc., forex clear at the London Clearing House, and really leading that way into OTC clearing. And we're only now starting to see the real gear up of what's happening in the world of OTC trading moving on to exchanges.
Well, again, as I said, I think there have been pockets where we were always concerned, for example, that the Eurostoxx futures might be taken over by Eurostoxx ETFs. So not necessarily OTC, but at least cash related. But they both fed off each other in the same way that I think he's probably talking his own book a bit there, obviously, given the fact that part of what he's doing very successfully now at EUREX is actually still pushing more product away from OTC and into a cleared and listed product. But so I think total return product is an obvious one there. It's looking at sort of OTC constructs which have ISDA agreements which look normalized, sort of transparent enough to be able to tweak them, to be able to make them into listed products fairly easily. And then at the same time, if you have a sensible way of allowing block transactions to be fed in, then what tends to happen is that it really is just a booking system to actually get those transactions into clearing to begin with. But of course, once you've got open interest there, then suddenly some of the players like the Optivas or the Virtues or whatever else of this world that are not there in the OTC derivative world in those products, then get the opportunity to start making markets on screen. And so they're, as with dividend products, you then start seeing some of that liquidity morph into the screens as well.
Yes, a very interesting point. So we're discussing evolving markets, evolving careers here with Brendan Bradley. We're into our last 10 minutes. We're actually well within our last 10 minutes at this juncture. Tell us a little bit more just about your book, the ESG book, because you've written ESG for Dummies. It seems to be a highly complex and convoluted topic, and nonetheless one that I think confuses a lot of people. So how do you break it down, Brendan?
I suppose one of the great things about Dummies books is the structure of it is such that you are forced, just by the way that you have to put the the actual chapters, bullet points, whatever together. It took me probably 3 months to go through that process with the publisher. And by the time you've done that, you've actually condensed things down into bite-sized chunks, which is kind of the whole process of what you really want to try and do. What I found was that I got involved in the project for the FinTech for Dummies, where I was asked to write 6 of the chapters for that. And then I kind of thought, well, why are we writing the FinTech for Dummies? And a large part of that was really that we figured that people were talking about FinTech, but bluffing it. So they were coming out with all the right buzzwords and whatever else, but actually didn't really fully understand what they were talking about. And so we felt we could do a good job of that. So therefore, for Dummies, for some people, that's a bit of a misnomer, really. I think it's just the structure of the book, and certainly some of the topics that we covered in the FinTech for Dummies wouldn't have been for dummies. There's certainly some of the blockchain and AI related sort of type material that's in there is good material. So I then picked up on that and kind of felt, well, if other people were bluffing it on FinTech, then I'm bluffing it on ESG, because I was coming out with all the right buzzwords as well, and the various phrases, but felt that I didn't know enough about it. And given that we went into a second lockdown, that really then gave me the opportunity to sit down and research that a lot more, understand kind of what was driving it. But for me, it's very much the investing part. So I'm not going to go into trying to determine exactly how we get to a net zero future in the book. It's more about what are the issues around looking at ESG as an investing approach. And some people would say is, could the real ESG please stand up? Because just having some indices that have exclusions for gun making companies or whatever the case may be isn't really what ESG could or should be around. So therefore, it's kind of going that next step past those ESG indices that the exchanges are launching at the moment, but actually going much more into the launch of green bonds, and looking at the renewable sort of side of things as well. The difficulty, I suppose, that I found was that as I was writing it, I felt that some of the early chapters were already kind of a little bit out of date, because things are changing so quickly in that area. And certainly now, having finished writing it 18 months ago, I wouldn't be surprised that I'm going to get the call from the publisher to actually almost do a rewrite or update, because certainly there's a lot of change in that area. But the one thing that still stands, now and was then, is there's a huge issue around the data, and who's using which data and why they're using it. And some will use MSCI as a kind of reference point, but largely because they're using MSCI as a benchmark with respect to their regular indices, and therefore they just morph into that. Whereas maybe what should be happening is that, and that's where DLT blockchain could come in, is maybe a golden source of data, where you could actually have corporates feeding their own data into something where you could then actually capture a golden source, and also then overlay that data with some sort of AI machine learning, to actually look for outliers in terms of the data that's coming through. But the issue, I suppose, with all of that is, who is it that is actually the central point of reference to receive all of that data, understand what they should be doing with it, and then feeding it back out to the market.
And on that note, as we deal with ESG, the fast-moving wonderment, and it's a terrific book altogether. I recommend it, ESG Investing for Dummies by Brendan Bradley. Brendan, we've come towards the end of our show, but it's that question we've got to ask everyone. And actually, in many ways, you were possibly living the capital market revolution even before I started writing, well, long before I started writing about it, but even before I got around to thinking about writing about it. So, Brendan Bradley, where do you think the capital market revolution goes next?
So I would look at it from a kind of two-pronged approach. One would be the product piece that we've been mentioning already. So I won't reiterate all of that, but there's plenty of product out there that you've got the catalysts that could be looked at, should be looked at, and there's the ability to do that. The other piece really then I think is the democratization of data. And that may well be looking at exchanges and how much money they make out of data and who it is that produces that data in the first place. But what are the ways in which that data can be brought together, whether it's the golden source that I just mentioned for something like ESG, or whether it's the idea of really, we've only scratched the surface on some of the machine learning that could potentially be utilized. How could that be used? And I think that's kind of the two different areas of that capital market revolution. It will be driven on one side by product, but on the other side by where the technology goes. As we said, unfortunately, DLT perhaps won't be as prevalent there, but who knows? If we look at the introduction of Web3 and the metaverse, maybe we don't have the imagination at this point in time to understand where that's going to drive a capital market revolution. And in 5 to 10 years' time, we'll kind of go, aha. So that was what was going on. And we really should have seen that one coming.
Fabulous altogether, driven by product as we head towards a golden source of data and in ESG, and indeed the data competition issue, the democratization of data, a point which was brought out also in show number 71 by Mark Shadle. Well worth checking that out if you're interested in the world of data, ladies and gentlemen. If you're interested in the world of EEX and products, and Brendan actually alluded to it earlier, do check out our earlier edition number 74 with Peter Reitz, the chief executive of EEX in Leipzig in Germany. This has been an absolutely fascinating show altogether as we worked our way through a multiplicity of topics around evolving markets and evolving careers with 3.5-decade veteran of the financial markets industry, derivatives specialist, product developer extraordinaire, Brendan Bradley. It only remains for me to say that coming next week, we have got a very exciting show once again with Balaji Prabhakar. We're going to be talking about accelerating the cloud. I think that's an interesting topic, building on what we were talking about with the good folks of Expree just a number of weeks ago, where they were talking about building cloud-based marketplaces. We're going to be talking about the ins and outs of how you actually do it and how you actually manage to do it with incredibly low latency. That should be a fascinating show altogether. Thank you very, very much to our special guest this evening, Brendan Bradley. It's been a joy. Pick up Brendan's book, ESG Investing for Dummies. Well worth a read. And thank you very much, let me say, to our fabulous list of commenters and questioners this evening. Chris Messina, great to see you again. Of course, Chris Messina, also one of our earliest guests and the first person to be on this show twice. Marcus Ward, Jonathan Cowan, Peter Second, Stuart Heath, thank you all for your interventions, questions and comments. Thank you most notably, Brendan Bradley, for being a fabulous guest altogether. And let me also say a word of great thanks to our production team this evening, Jamil, Janella, Racy and Beata. My name is Patrick L. Young. I wish you a great week in blockchain, albeit things are #it's complicated at the moment with FTX and the ASX debacle. Life and markets. We'll be back same time, same place next week.